Recent news reveals a troubling trend in the stock market: the disappearance of short sellers, also known as bears, who played a crucial role in driving the market's recent rally. These skeptics, who had initially positioned themselves for a market downturn, are now retreating as stocks continue to surge. This shift in sentiment is evident as bearish positions in exchange-traded funds hit a 3-year low, and short positions in S&P 500 futures were unwound at a rapid pace. On the other hand, the number of bullish investors is skyrocketing, with bullish newsletter writers outnumbering bearish ones by a ratio of 3-to-1, the highest level since late 2022. The absence of bears in the market is cause for concern as the Federal Reserve's battle against inflation regains attention and corporate earnings are predicted to decline for the third consecutive quarter. While sentiment remains stretched but not extreme, recent surveys suggest that the market may lose the tailwind provided by positive sentiment. As the second half of the year approaches, investors are expected to demand results that justify the market's recent performance, potentially putting the market to the test. In recent weeks, stocks experienced a decline due to worries that the Federal Reserve will continue to raise interest rates to control inflation, resulting in rising Treasury yields. All major equity benchmarks, including the S&P 500, ended the week in negative territory. Short sellers have suffered significant losses this year, with estimates suggesting that they lost $37 billion in June alone. Despite their losses, the market's optimism surrounding artificial intelligence and technology giants has propelled the S&P 500 to impressive returns, defying predictions of doom. Data indicates that skeptics are retreating, with hedge funds unwinding their net short positions in the S&P 500 at a significant rate. Newsletter writers classified as bullish have surged to 54.9%, while bears have dwindled to 18.3%. This is a stark contrast to the situation at the end of the previous year, when bears outnumbered bulls. Even seasoned market analysts like Ed Yardeni have raised concerns about the growing number of optimists. High bullish sentiment is viewed as a cautionary signal. Short interest in exchange-traded funds is at a 3-year low, and short interest in individual companies, though not entirely dissipated, has returned to median levels across most industries. Money managers who base their decisions on rules and algorithms have been compelled to purchase shares as the market continues its upward trend. Systematic funds, which rely on price momentum and volatility signals, have been net buyers of global stocks, estimated at $40 billion to $45 billion in June. Their purchases over the past 6 months represent the second fastest rate of buying in history. This news highlights the fragility of the market's current situation. The exposure of quantitative-based funds to equities has reached its highest level since February 2020. If their exposure were to return to the historic median, it could result in share disposals of up to $160 billion. However, for now, market pullbacks remain shallow as traders await more economic and earnings data to gain a clearer understanding of the fundamental outlook. The S&P 500 has maintained a streak of resilience without a weekly decline of 2% for 17 consecutive weeks, the longest in almost 2 years. The upcoming earnings season will be initiated by major banks, and analysts predict a 9% decline in second quarter profits for S&P 500 companies. Despite the market's current lack of confidence in the economy, active funds have pursued gains in AI-driven technology stocks, while reducing exposure to economically sensitive companies such as energy. This aversion to cyclical shares reflects the belief that an economic recession may be delayed but not entirely avoided. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So, before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching. Now let's get into it. We begin with a noteworthy development: the retreat of short sellers or bears from the market. These skeptics, who are preparing for a market downturn, have been stepping back as stocks continue to rally. This shift is evident from the decline in bearish positions in exchange-traded funds, reaching a 3-year low, and the unwinding of short positions in S&P 500 futures at a rapid pace. On the flip side, the number of bullish investors has surged. Bullish newsletter writers now outnumber bearish ones by a ratio of 3-to-1, the highest level since late 2022. Such optimism has played a significant role in the market's recent performance. However, this absence of bears raises concerns as the Federal Reserve's battle against inflation takes center stage, coinciding with projected declines in corporate earnings for the third consecutive quarter. While sentiment remains stretched but not extreme, recent surveys suggest that the market may lose the tailwind provided by positive sentiment. As we enter the second half of the year, investors are likely to demand results that justify the market's recent performance. The past week witnessed a decline in stocks due to concerns over the Federal Reserve's interest rate hikes to curb inflation, resulting in rising Treasury yields. Nevertheless, it's important to note that the market has shown resilience, with the S&P 500 not experiencing a weekly decline of 2% for 17 consecutive weeks, the longest streak in almost 2 years. Short sellers have faced significant losses this year, estimated at $37 billion in June alone. Despite these losses, the market's optimism surrounding artificial intelligence and technology giants has propelled the S&P 500 to impressive returns, defying pessimistic predictions. We also observe a retreat of skeptics, with hedge funds unwinding their net short positions in the S&P 500 at a significant rate. Newsletter writers classified as bullish have surged, while bears have dwindled, indicating a stark contrast from the end of the previous year. It's worth mentioning that market experts, such as Ed Yardeni, have voiced concerns about the growing number of optimists. High bullish sentiment can serve as a cautionary signal. Short interest in exchange-traded funds has reached a 3-year low, and short interest in individual companies has returned to median levels across most industries. Quantitative-based funds, driven by rules and algorithms, have been actively buying shares as the market continues its upward trend. Their purchases over the past 6 months represent the second fastest rate of buying in history. However, the market's current situation is fragile. The exposure of these funds to equities has reached its highest level since February 2020. If their exposure were to return to the historic median, it could result in significant share disposals. As we move forward, it's essential to monitor economic and earnings data to gain a clearer understanding of the fundamental outlook. Where do you think the stock market is headed? Are we going higher from here, or will we see a dramatic pullback or even crash in stocks in the coming months? Let us know in the comments section below, and remember to subscribe to our channel. That's all for this update. Stay tuned for more insights on the economy and market conditions.